Hey, welcome back to the Financial Beast Podcast. Of course, your BFFF, best financial friend forever, Eric Miller, and just another Between Two Erics, which of course, me and my advisor, or one of my advisors, Eric Gersch, kind of go over certain topics. Today, we have global markets melting down right now, which is something that's pretty predictable. It happens, every few years, and the response of most people is the same, to want to panic, to want to, kind of look at alternatives. And, we just talk through it. And, the planning for a meltdown should have been done prior to the meltdown so that you don't really have the effect of the meltdown when it occurs. So we talk a little bit about that and a lot more. I think you guys will like the conversation. It's pretty short, but it gets right to the point. And as always, please, guys, give me a like, give me a share, subscribe mostly to the podcast. We really need you guys to subscribe, and that would really help us, continue to put out the content like this. And then, if you are in a position right now where you're a healthcare owner or an associate and you guys need financial help, don't wait. Waiting is not a strategy. You need to go directly to our website, econologics.com. You need to schedule an introductory call, and our people will take care of you. They will listen to you. They will answer your questions, and then they will help you. So I definitely want to make sure you guys understand that and know that. And I'll see you on the next podcast. Take care. All right, we're off. Another edition Between Two Erics. Been a while. Where the hell you been?
Where have you been?
I mean, I've been here every day. But then you ghost.
Jury's out on that one.
Every single day I'm here.
I think you are. I am too. Well, I used a lot of PTO in July. I saved it up all year.
There you go, folks.
Saved it up all year, and then you made me use it or lose it. So really, when you think about it, it's kind of your fault.
I made you use it or lose it.
I mean, if PTO rolled over,
yeah,
I wouldn't have used it. I would have been here.
Just roll it over so that you can just take 6 months off whenever you want to. Is that right?
Yeah.
Okay.
Yeah. That would be nice.
We'll see how that goes. All right. So as we speak,
the stock market is melting down.
Global markets are melting down right now. So, okay, this is this it? Is this it? No.
No. I mean, at least as of this point, and don't get me wrong, none of us, of course, know the future, and it could get worse, of course, yada, 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 and it looks like it actually has got worse today.
Has it really? I thought it was screaming back last time I checked.
No, as of it fell this morning, and it's kind of regained what it lost this morning.
Yeah. Anyway,
but I mean, long story short, where I was going with that, anyways, is this crash. When you look at it on even like a 5-year, this crash is like 1/15 of the gains that we've had over the last 5 years. It's a nominal amount that isn't even a blip on a long-term radar.
So why is it that every time this happens, and you know what, I'm going to say, I mean, because we wanted to talk about like what to do when you see this kind of sell-off,
Yeah.
Because although I don't think we get a lot of phone calls, maybe we get some. Couple. Yeah, we get some. But I mean, this happens like pretty routinely.
Every couple of years. And it's happened, the last 5 years have kind of been a exception. It usually doesn't happen 3 times in 5 years because you had 2020, 2022, and now if you want to throw this in the category 2024, usually I don't even remember
2022, to be honest with you. I don't even remember that we had one of those.
2022 was down 24%, dude.
Was it really?
The year as a whole, yeah. 2022 was the worst year in a while.
I don't even remember that.
Exactly.
I don't even remember that.
All of it back up in 2023 and more in 2024.
Yeah. It's crazy. I mean, it's like these market meltdowns are, number one, predictable, is that they're going to happen at some point in time for a number of reasons. And I'm not like, because I'll listen to macro people talk about like all the reasons why this is happening right now. But nobody knows what triggered it. There was something in that created a sense of fear in enough people where now there are more sellers than buyers.
And it's temporary. It always is.
Pretty much that simple.
No, you're not. You're right. It's a open market. So
I guess we got to give somebody some practical advice here, don't we?
What not to do, or what to do? Excuse me.
Well, we have these events that happen, every few years, where there's seemingly some kind of a crash, and whether or not this is actually going to turn into something or not, or this is just like a pretty normal pullback. I don't know.
Yeah.
But I mean, it's every once in a while we'll have something significant where you'll see a 30 to 50% pullback. Right. And I don't know that this is going to be one, unless there was something that catastrophically happened. Yeah.
I mean, I'm looking at it right now, and this quote unquote pullback, we've lost half of the gains that we've had this year.
Yeah. So the markets are still up on a percentage basis this year.
Yeah. I mean, the S&P 500, right? That's probably the most well-known measurement. The Vanguard S&P 500 is up $63 this year prior, and it just fell 31. So we're still up 8% this year.
Yeah.
Even with all of this factored in.
Yep.
It's not the end of the world. It's not worth losing sleep over. It's not, honestly, the best thing you can do is just put your head down and go to work and pretend it's not happening. And before you know it, it'll be over and the markets will be rebounding. If you don't not reacting is the best reaction there is.
I mean, you certainly never want to make a decision in a sense of panic or confusion. That's for sure. I don't know why this would be a confusing. Nothing substantially has changed in our system at all where it would indicate that there was something to panic about. No. Banks are still lending. Credit is still available. I didn't see any big financial institutions go bankrupt. I didn't see anything, you know what I mean? Like there's not a government shutdown that's going to cause, a lack of production or anything like that. So what would the panic be that would cause a 25 to 30% correction? I don't think there is one.
There wouldn't be.
Yeah.
It wouldn't fall that much without any big reason. It might fall 5-10% for, just a quick pullback, but it's not going to fall 30% without a huge catalyst causing it.
Let's say there is one. Okay. What are you going to do?
Nothing. Yeah.
And this goes to how prepared you were prior to the pullback, right? This goes back to what your preparation was and how you are. Because I would dare say because we manage hundreds of millions of dollars for people, right?
Yeah.
How much of the money that we have invested right now for people that we're managing are they actually using for current income? Do you think?
Oh God, 1%.
Very small amount, isn't it?
Yeah, if that. That's probably it's probably not even.
Yeah.
I mean, nothing.
Yeah. So most of the time when people start having reactions to, oh my God, what's happening to my investments? What's happening to my money? And I'm just like, Are you taking any income from this? No. What are you worried about then?
And that, to take that a step further, even if you are taking income at the current point in time, if we're managing your money, you're going to be positioned in a way that isn't, super aggressive. So if the overall market does fall that 30%, sure, you're going to fall, but you're probably only going to fall 7 or 8%.
Yeah. Yeah, for sure.
So,
yeah, because if I looked at probably our allocation, it's still probably pretty heavily in fixed income at this point in time.
Yeah, I mean, if you're 10, 15, 20 years out from withdrawing from your money,
yeah,
today's events are beyond unimportant.
No. And how much, and let's even go a step further. Let's say that this is indicative of a quote unquote recession or even worse. Right? Or even worse.
A depression.
You just love to say that, don't you? You just want to see. You want to see
the Great Depression 2.0.
You want to see what like soup lines look like, Gersch. You just want to see people like just in the. I
want to watch the world burn.
You want to see people in the streets like despondent right now. I mean, people are like, we're going to enter another Great Depression. I'm like, man, have you ever been to some of these cities? We're in one. You know,
some people are.
Some of these people that are homeless. I mean, good gracious, man, look at some of these cities, downtowns.
Oh yeah, when I was out, and not to get lost anything, but when I was out in Seattle, man, beautiful city, beautiful,
one of my favorite cities.
But you would have these high-rise, multi-million-dollar condos, and then on the side of the building was a row of tents.
Yeah,
and I mean, there's definitely, I don't want to get lost in all of that stuff, but there's a jarring difference in the world that Americans experience. We're not all experiencing the same prosperity or the same America.
No. And I think when you start looking at the people that we talk to, which are mostly professional people that have, mastered a skill, run a healthcare practice, what do you have to be worried about if we get into any kind of economic crisis? Well, guess what? We already had one 4 years ago. Yep. That was about it's not as bad as it could get, I guess. I guess it could get worse, but when people aren't allowed to work, people aren't allowed to go out of their house, people aren't allowed to do anything, that's pretty bad.
Yeah.
And how did healthcare businesses do for the most part?
They might have struggled for a couple of weeks and then they rocketed back.
Yeah. I mean, I think you guys got to look at like what kind of business that you're in. I mean, that's generally where most of your money's coming from anyway.
Yeah.
And so I don't really see why any market meltdown is going to have a profound impact on your daily life, other than, we get stressed out because we manage so much money.
Oh yeah. I mean, it's very stressful because you're looking at client accounts and they're falling and it's not a great reason why.
Yeah.
And there's not a clear path to an end. It's like, are they going to fall 8%? Or are they going to fall 18%? I don't know. But when you're in the midst of a market meltdown, I don't even know if I want to use the word market meltdown for this, because that's just, that's kind of an extreme terminology for a small fall like this. Market correction.
There you go. Correction.
But when you're in the middle of a market correction, it's too late to do anything, right? You're not going to, it's too late to change your allocation or whatever, So you just,
you're not going to move all your money. You're not going to move all your money to T-bills right now.
No,
you're not going to.
Time to do that was 3 weeks ago. But why would have you done it 3 weeks ago? 3 weeks ago, things were booming. This is part of investing. There is no magic 8-ball where the future. You just got to look at trends over the long run and make an educated decision based upon that.
Not only that, but you got to look at what amount of public securities. That's all we're talking about right now. I mean, these are These are public securities, stocks and bonds.
Yep.
How much of that makes up your entirety of your household portfolio?
Yeah.
And by and large, what would you say a average healthcare practice owner that, has a business and they're building?
Oh, it's usually sub 20%.
Sub 20%.
A fifth, if that.
So less than 20% of your portfolio is subject to this kind of risk that we're dealing with.
Yep.
Right. And so by and large, even if that went to zero, theoretically, it wouldn't have that much of, it would not have that much of an impact on the entirety of your household portfolio.
No, and it's not going to go to zero,
How do you know, Gersch? You don't know?
The market's been around since 1870 and it hasn't gone to zero yet.
That's just like that's like a brief breath in eternity, man, when you think about like the length of time. Come on now.
It could go to, I guess it could. If the market goes to zero, our owners,
I know what you mean.
We're all going to have bigger problems, for that to occur. It would be like the end of civilization.
So yeah, I'm not, I think
not worried about that.
I'm definitely not worried about that, but, well, what can we tell people to do then? Besides just like, well, just don't do anything, sit back, wait. Is that really?
Honestly,
is that really it? Come on now. You have no more brighter advice than that right there.
That's the best advice you can possibly get.
Wow.
Honestly, the worst thing you can do is start selling when things are dropping. You should actually be doing the opposite. You should be buying right now because we know the market is going to bounce back. So you can look at this and you can say, would I rather buy at full price or would I rather buy at 10% off?
So is this the argument right now for the dollar cost averaging approach for most people?
To some degree, yeah. Dollar cost averaging is just going to average out your cost over the long run because you're buying when prices are here, and it all averages out to here.
Yeah, but it certainly is a lot easier to take from an emotional standpoint.
Oh yeah, but what I'm saying right now is if you have extra cash, now is not a bad time to buy into the market.
Yep.
Buy high. Wait, buy low, sell high. I almost said it backwards. Buy low, sell high. And the reality is human nature is to do the opposite. Human nature is to buy when it's high because it's been growing. So why would it stop growing? And sell when it's low because it's already fallen this much. And what if it falls that much? So I better sell now. Do the opposite. If you do the opposite of what you naturally want to do when it comes to public stocks, that's how you're successful.
I just don't think people really, do they still do that? Does people still liquidate?
Oh, yeah.
Really?
Yeah. I've saved millions of dollars of money from getting liquidated.
Really?
Not from this one, but from like 2022. Oh, yeah.
Wow.
Yeah.
It just makes me wonder how much education people actually need when it comes to investing in public securities.
Well, they think, it's just like free falling out of the sky and there's no bottom to it. And I better cut my losses now. I'd rather walk away with 75 cents than no cents, but that's just not logical. Thankfully, our markets don't work that way.
Yeah, that's true.
But yeah, that's the best thing you can do. I don't know what do I think? Know what would be better.
Well, I mean, look, I mean, certainly a strategy of taking a pause and thinking about what you're doing, and certainly not having a lot of attention. Again, I think it all goes back to what was your strategy before this? And if your strategy before this was, when I look at my household portfolio, I got 50% of it is made up of my business, which I have control over. I have another 20% in real estate of some kind. I have maybe another 10, 15% in like safe money, like, annuities, cash value, life insurance, somewhere around there. And then I'm going to put, another 10, 15% in public securities. And I'm willing to roll the dice on that amount because, I mean, historically it's been a place that I can get, 8 to 10% returns.
Yep.
So that way going into something like that we're experiencing right now, it's like, all right, well, I knew this was coming. So why am I surprised? And, I'm just going to make sure that it remains 10 to 15% of my overall household portfolio. I'm going to keep in these public securities. That's it.
Yep.
So the time to like really think about the plan on this was prior to this event happening right now. I think that's
kind of what we set up through our whole planning process. And everybody's different. You say 15% in public securities, but what if I have a very small practice and I don't own the real estate? I might have 30% in public securities.
And you might.
But even then, you're still talking, 30 cents on the dollar. You still have a lot of wealth outside of public securities.
Yeah.
And a decline in public securities of 10% in that case, if 30% of your money is in stocks and those stocks fall 10%, your net worth is only falling 1/3 of 1%.
Yep.
So you just got to keep it in perspective, I guess.
I think that is definitely the most important thing is like, look at the percentage. That's the first thing I'll do with most people is I'll be like, all right, let's look at what's being affected of your overall household portfolio.
Yep.
All right. This represents this percentage. And even if it went to zero, you would still have income coming in from all these different sources. And your lifestyle would not be affected one iota from it at all. And that's kind of the simplicity of it right there. I think that's how I would handle that. I'm assuming that's what you guys do when you're talking.
Yeah, you got to be. All of us advisors here are always looking at, setting up income streams that aren't tied to the stock market directly. So, if you have a number of those.
And about how much do you want to create of that kind of guaranteed income?
Enough to cover your basic guaranteed expenses.
Yeah.
No, like enough to
no, I get it.
Cover your groceries, your property taxes, your car insurance, your requirements to be a functional adult.
Yep. And that amount, and then anything else that would be on top of that would basically just be discretionary money.
Yeah. If I've got my needs met with guarantees, everything on top of that's discretionary. It's my hobbies, my travel, my, so on and so forth. So I can invest more aggressively in that situation because I know my needs are already met. So I can be more aggressive with the rest.
Yeah, I agree with that too. How many people actually buy the dip?
I did.
Besides you.
Not enough.
Realistically, how many people actually do that?
5%.
Do you see it all the time right now? I mean, you can go on social media, people buy the dip. And I'm like, I wonder how many people actually do that.
Very, 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 very few. It's very hard in my experience to get somebody to actually buy the dip. Because here's what people worry about. Oh, okay. So let's say we're down 10% today. Oh, I don't want to buy in yet because it might fall 15%.
Yep.
And then it falls, let's say it does fall to 15. Well, it's definitely going to go down to 20. But then that doesn't happen. And now it goes up. And now we're only down, say, 6%. Well, then they're like, oh, well, it's probably going to fall back to 15. I don't think this is real. Next thing you know, it's positive. It's higher than it was before the crash. And then they're like, I should buy that. That's what happens.
And they never do.
No, it's very hard to get people to buy the dip.
This is why you have to set up your savings and investments systematically and automatically. You got to set this up so that you're not thinking about it and just have it set up in a manner where it's just coming out of your accounts on a regular basis. I just don't think people have the stomach for doing the kind of real value investing or that kind of investing to make it work.
Yeah, no, I mean, our average client does not have the discipline.
Why should they?
I don't know if discipline's the right word. They don't have I don't even know if they have the time to watch the markets and invest when things are down. And it just doesn't get done. It falls by the wayside. There's too many other things to do. I have the time and I'm paying attention to the markets all day. So, and let's be honest, my knowledge is higher than that of the average medical professional. My knowledge in finance, their knowledge in medical is significantly higher than my knowledge. This is my specialty. That is theirs. So for me to buy the dip, that's easy. I know all the odds. I know all the what ifs. I know what people go through. But for your average American in general, they're better off, like you said, dollar cost averaging, setting up which just means making your savings automatic where you invest $1,000 every month or whatever it is.
Yep.
If you do that, you're going to be successful over the long run.
You really will.
You're going to be a lot more successful than saying, oh, I'll pay attention to the markets and buy the dip and never buying anything because life gets busy.
No, I mean, I've had too many clients that have set up these early systematic and automatic draws from their business profits into whatever accounts, honestly.
Yeah.
And it's like 10 years later, 8 years later, 7 years later, there's $600,000, $800,000, $1 million sitting in there.
Yeah. When you make it automatic, it happens.
And it's just like,
it's out of sight, out of mind.
So what happened that you have this amount of money here? Was it the returns on it? Not really. Returns are going to be a bonus, but it just happened that the habits and the routine was what actually caused that to occur.
Yep.
And that to me is what was important about that. So, all right. Well, I think we've killed that. Anything else you want to say?
Buy the dip.
Buy the dip.
Don't freak out. Life is going to go on. We're going to be okay.
Good advice. All right. We'll see you guys next time.
Next time.